I'm just going to cover off on three things very, very quickly this morning. The first thing is I just wanted to, for those of you who have books, which I think are the folks here, maybe not the folks there on the other side, but I just wanted to point out three things very quickly, if I may. If you go to slide 8, the first thing is that we've had a very large impact from price reductions over the last year, almost $8 billion period on periods just for the 6 months, so huge impacts. But nevertheless, this organization continues to generate very strong cash flows. So 40% EBITDA margins, which even at these prices remains well above anybody else in the sector. So we generated $6 billion of EBITDA and $5.3 billion of net operating cash flow. Underpinning all of that, yes, there is the costs, the prices that are falling, but so have costs and the productivity gains continue to be generated, and we've guided another $2 billion for this year on top of the $10 billion that we've already delivered, and you can touch and you can feel in lower unit costs. Second thing I just wanted to point you to, if you may, slide 12. The balance sheet remains very strong. No doubt about it. We were reconfirmed A by S&P on Monday last week, and Moody's, which has been taking a knife through every single oil and gas company and every single mining company. They confirmed us at A3. So essentially, still we are very solid A, as we always have been and always intend to be. So in good shape from low-cost assets, well-protected, additional productivity, and a balance sheet that's in very good shape. Third slide I wanted to turn to, slide 17. The dividend, obviously a very big issue, no doubt about that. The change that was brought this last reporting period, we reduced our dividend from 62 cents in the previous period to 16 cents. No doubt that is a huge change there, and of course we changed our dividend policy from progressive to payout. What didn't change? What didn't change was, in fact, essentially the capital allocation framework. So the capital allocation framework remains. First, we need to allocate capital to maintaining the existing gear. There's $2 billion associated with that. That hasn't changed. The second thing is we need to look after our balance sheet. That is a solid A through the cycle. That didn't change. And as I pointed out a moment ago, that is in good shape. The third thing is, and this did change, as I say, that what didn't change was the next amount that's allocable is, of course, cash returns. And in this case, the policy changed so that there is a minimum 50% payout of attributable earnings. Thereafter, any excess cash gets to compete between additional returns to shareholders, either in the form of buybacks or additional dividends, or for further investment for value in the organization long term. So we believe that the cut in the dividend was necessary because of the very large reductions in prices, particularly oil. Oil was the one that really surprised us, that caused us to move from where we had been, which was feeling that we could continue to pay the progressive. That's the big one that changed, and it's needs must. And the second part of the decision was the change in the dividend policy. The progressive was fine because you had a world of basic stable, up, a growing demand with lagging supply. That happened to be for 10 years. That's fine for at that point to have a progressive, but the world is a very volatile place. China is making transitions. The rest of the world has lots of stresses and strains. So there is volatility. It's inherent, and we need a dividend policy that allows us to flex with that. But the last thing I'd say, this dividend policy, the point of this dividend policy in a world of volatility will enable us at the bottom to continue to protect our balance sheet, which is paramount, as well as continue to invest for value, particularly at the bottom of the cycle, because it's counter-cyclical investment that makes a difference. But when we get to the top, of course, there will be a guarantee of very substantial cash payments to shareholders. So we believe that the dividend policy in this world is a value maximizing and a dividend maximizing approach to the dividend policy.